Hi everyone. Are we heading for a 1970s period of stagflation? What performed well in that period? And are the 2020s going the same way? Well, in this video we'll find out. I'm Anthony, and as always, we're talking money. Well, what a difference 6 months make. It wasn't long ago we had record low inflation, interest rates at just 0.1%, the lowest they've ever been. The economy was just getting back after the devastation of the pandemic, and the future was, well, looking relatively rosy. Roll on 6 months and we've got inflation relentlessly increasing to the highest point really within the last 15 years. Natural gas wholesale prices have quadrupled, shortages at the petrol pumps, labour shortages in many industries, and wages increasing in some key sectors, and the threat of factories closing down because they can't afford to keep their machines running. It all sounds very much like the start of the 1970s, where the oil-producing countries in OPEC decided to hike the cost of oil by restricting supply. However, some would argue that the catalyst for this was Nixon's decision to decouple the American dollar from the gold standard in 1973, allowing the dollar to float freely. The effect at the time was a fairly severe dollar depreciation, about a third, which led OPEC countries at the time who held lots of dollars to retaliate by restricting oil supplies. The thinking was that if you're going to get less selling a barrel of oil in dollars, then restrict the supply to at least send the price of each barrel upwards. Anyway, the ramifications are now well known. With a devalued dollar, and more importantly an unpredictable dollar, imports became more expensive. And with a higher oil price, everything became more expensive to make and therefore to buy. And the 1970s were dominated by an increased inflation rate and a nightmare of a restricted economy, leading to an increased unemployment rate. The term stagflation was first coined by a politician in the UK, Ian MacLeod, in the 1960s, describing an economic dystopia of low growth or stagnant growth and high inflation. The prevailing theme at the time in economics was dominated by Keynesian economic theory, which can be summarised simplistically by saying that when growth in the economy slows, it can be promoted by the government using its fiscal policy to reduce unemployment, and there accordingly the economy picks up. In more detail, Keynes believed that the government had a key role in the balance between unemployment and inflation, the two having an inverse relationship. It could intervene to adjust the balance between these two aspects. Intervention took the form of either tax changes or changes in government spending to either stimulate or suppress the economy. Such was the strong relationship believed between unemployment and inflation. Anyone studying economics at the time placed great emphasis on the non-accelerating inflation rate of unemployment, or NAIRO for short. I remember learning this so much when I was studying economics. This was essentially an unemployment rate synonymous with the stable inflation rate. But the 1970s threw all this into the air. What would Keynes do, for example, if inflation and unemployment were going up together? This, in theory, shouldn't happen. Increased unemployment should reduce inflation. So a Keynesian stimulus to try and reduce unemployment would send inflation even higher and actually make the problem worse as the economy tanks even further. Step forward the next economic heavyweight, Milton Friedman, who essentially said that Keynes was wrong in his fundamental understanding between unemployment and inflation. He maintained that inflation is always a monetary problem, i.e. too much money in the system, or rather more of it being added to the economy compared to the growth rate of the economy. He essentially believed that prices would not go up without an increase in money supply. A Friedman solution was to restrict the money supply, take money out of the system, achieved effectively by hiking up interest rates. Credit available goes down, savings go up, and money essentially is taken out of the system. Interest rates and the control of money supply into the economy became key policies in the UK and US in the late 1970s and the early 1980s. Both economies went into deep recession, and inflation was eventually tamed and kept under control. So, was a sharp recession the cost of getting us out of stagflation? In short, yes, it was. The best analogy of these two ways of thinking is to imagine, you have to bear with me with my analogies here, is to imagine an aeroplane. Its height is inflation, its speed is employment. In normal times, Keynesian economics would use the elevator or fiscal policy, seeing that there is a relationship between height and speed. They would pull back on the elevator, and as the plane gains height, the sacrifice of speed, and vice versa. But during a stall, stagflation, you are losing height and speed. Constantly pulling back on the elevator to gain height makes the problem worse, and you end up losing more speed and more height. Friedman's solution was to level the elevator, drop the nose to lose height and pick up speed first, and then use the throttle, monetary policy, and elevator at the position to maintain a steady climb. The key was to lose height first, i.e. a recession. Now, I probably murdered that analogy, and I appreciate it's not perfect, but essentially it's to do something counterintuitive. It's to restrict money in the economy to bring inflation down first, and once that's under control, then you can control the economy from there. Anyway, enough waffle on what happened before. Is the same happening now? Well, we haven't had a currency devaluation yet, although we have had a supply shock in the form of gas prices and supply shortages, etc. The Bank of England is continuing to pump money into the system to stimulate growth and keep unemployment low, but the sacrifice is inflation is taking off. The bank has an awful job to do at the moment because it's seemingly taken on a dual remit of keeping inflation low, which was its initial remit, and now to keep unemployment low too. And as we saw in the 1970s, the policy to control one can have an adverse effect on the other. So which should take priority, inflation or unemployment? The added complication is that no one yet knows what impact the ending of the furlough scheme is going to have, and whether the gas price and supply shortages are just a temporary phenomenon resulting from our adjusting out of the pandemic restrictions. This is one reason why stock markets are so volatile at the moment. Every bit of economic data either slews the story one way or another. And when does the bank decide that inflation is at a level that it needs attention? Is it 3%, 4%, 10%, 15%? No one knows. The theory that all of this is temporary and the problem will sort itself out by 2022 is an attractive narrative. But the problem with inflation is it can become self-perpetuating, especially when wages start to be adjusted for anticipated inflation rates. You're going to ask for more if you think that inflation is going to erode your purchasing power. With more money in your pocket, after a pay rise, you can afford to spend more on those more expensive things, and so inflation goes up and up accordingly. A wage spiral can develop, fueling inflation, even if the initial causes of inflation have long gone. I can't honestly tell you whether we're heading for a 1970s type of stagflation. No one can, and if anyone says they can, they aren't telling you the truth. If economics teaches you one thing, it's terrific at telling you 20 reasons why something's happened in the past, but hopeless at telling you the one thing that's going to happen in the future. However, one thing we can do is to have a look at what did well, if anything, in the 1970s, and at least then we can be prepared if the economy heads that way. Well, as I've said before, the worst assets to be in times of inflation are government bonds, or US treasuries, government gilts, whatever you want to call them, and cash, as you're guaranteed to lose money. But what actually did well in the 1970s specifically? Well, real assets tended to do quite well, or at least kept pace with inflation. Real assets include things that you can stand on, you can pick up, you can smell, you can throw, things like that. So real assets include things like land, forestry, farmland, and certain property. I say certain property because rental property tended not to do so well since the government introduced rent controls limiting the upside from an investor's point of view. And before you say that we've now got assured short-hold tenancies in our residential market rather than regulated tenancies before, don't think the government can't intervene and change the rules. It did this just last year when tenants could not be evicted from their houses even if they failed to pay the rent on time. Properties that are not under this threat of government control may do better, such as farmland, forestry and commercial. Gold went up tenfold during the 1970s, providing perhaps the best evidence that indeed gold performed well as a hedge against higher rates of inflation. Interestingly, silver performed even better. While real assets generally do quite well, financial assets are not all bad. The 1970s were not kind to stocks in general. For the 1970s decade, for example, stocks reduced in real terms by 49% in America, and in the UK they did even worse. The top stocks, known then as the FTSE 30, lost 73% in the worst bear market since the Great Depression. Imagine that now. It would mean that the FTSE index would fall from its current level of about 7,000 to a staggering 1,900. That's 7,000 to 1,900. Boy, that would just be a terrible scenario. However, if the home markets are doing badly, what about foreign markets? Generally, if the home market is doing poorly, somewhere in the world is doing better. In the case of the 1970s, the Japanese stock market trebled in value. Now, one theory is that if a falling value of a currency is synonymous with inflation, there must be another currency that is appreciating in value against it. Indeed, the Japanese yen appreciated considerably against the dollar, so much so that the Japanese government had to intervene to stop the yen getting too strong. Its stock market loved it, and as you can see from the graph. If you are to invest heavily in shares at the moment, and let's face it, many of us are, even if we don't directly, say in our pension funds for example, some shares did surprisingly well in the 1970s. Not surprisingly, if commodities do well, then those stocks linked to commodities also did quite well. Have a look at this graph. Energy stocks did well, i.e. oil and back then coal stocks. And interestingly, those that invested in property, another real asset, also did well. Everything else seemed to do not so well, and as I said right at the beginning, government debt does particularly badly. Cash, which isn't on the graph, would have done even worse. Anyway, let me know what you think about the economy. Are we heading for the 1970s, or is all this overblown and come next year we'll be back on track? Are shortages and energy spikes just that, spikes, and all will be calm before too long? What are you investing in at the moment? Property, shares, commodities? Well, I hope you enjoyed this video. Click the like button if you have and subscribe if you haven't done so already. It really helps this channel out. But I'll catch you in the next video. I'm Anthony, and as always, we're talking money. But until the next one, bye for now.